Welcome to the daily update, where I'll go over the action in the market for Thursday, January 4th, and then we'll see how things look for Friday, January 5th. We've now had, five down days in a row? Okay, not really a good start to 2024. We had been seeing some positive seasonality, and the technicals were pretty strong. And there was a lot of assumptions made that we were just going to naturally keep going higher as we got into the new year. But the exact opposite of that is happening right now. We're seeing some weakness really start to develop in the charts. We're pretty much worked off the short-term extreme positive or overbought condition. We still have kind of a long list with the intermediate term, but now we're starting to see some weakness drift into the intermediate term charts. We're still hanging in there okay with the long-term charts. We do have the employment situation report and a big inflation report that will be coming out in Friday's session. Maybe that will give the market some direction, especially if it's taken as market friendly. If it comes in hot or unfriendly to the market, we could see things really start to escalate to the downside. So let's go back and talk about what happened. Right at the open, we had a flat open and prices were positive right out of the gate. And it looked like, okay, maybe we're going to get a bounce up off of the 20 period moving averages. Well, we did there for a little while, but it's not how the market opens, it's how it closes. That's the important part. We were able to rise above the daily pivot at 47.11, and then we got up to R1 at 47.23. Then we fell back down below the daily pivot to the unchanged level, which is kind of a built-in support or resistance level. And there's some typing here. This is Cleveland tried to find support. We got to the unchanged level. That's what's supposed to be typed here. But it went negative and we fell below S1 at 46.93. So we fell under the 47 level and we closed right at the low. That's the important part, is that we saw weakness going into the close. We were down 0.34%, so not all that much on a percentage basis. It's more people's confidence is kind of getting rattled, and that's what the market wants. It doesn't want to assume that the market's just a cash machine where you're going to magically put in money and it's going to go up just because you want it to, just because that's what it's already been doing. No, it likes to create doubt. It likes to climb a wall of worry, and when this excessive optimism that we've been seeing gets too out of hand, the market really has a way of shifting things around. We are still above average with volume, so that's starting to pick up again. And we're positive with the technicals, but we're starting to show some weakness. And we've been working off a lot of these extreme positive conditions, but we still have a lot. With our stochastic chart, we're both extreme positive and negative at the same time. That's always kind of interesting. We'll have to see what the inflation situation is like after Friday's session, and then what the employment situation is like as well. Is the market going to like that or not like that very much? Mega caps did underperform and they experienced some late day selling, and that is usually not a good thing. I understand there were some downgrades on Apple, and that Apple's such an influential stock that it ended up really having an impact on the NASDAQ 100 and the S&P 500, as well as the Dow, even though the Dow finished up. And no, we're not going to have a Santa Claus rally. It looks like Santa gave all his Christmas cheer out in 2023. We're trying to understand now, is the January effect actually over, or is this just a little bit of a down move before it gets set to go back up? We don't know that yet. Right now, it's kind of under pressure. Small caps did outperform. Even though they were down on the day, they held up a little bit better. Growth continues to underperform value, and that's been a concern pretty much throughout the month back into November and into December. We've seen a real negative divergence between the S&P going up and growth going down on a ratio basis. That's still continuing. The S&P is now below 4,700. We have just our ADX, which is dropping below its moving average. So technically, it's not extreme positive anymore. The reason why I still have it on the list is we're still above 40, and we don't get to that 40 level very often. And as I said, part of our stochastics chart is still extreme positive, the longer term part, where the short term part has already gone extreme negative. We do have a little bit of a lengthening list with the extreme negative or oversold conditions. The Williams percent R, the Stoch RSI, which has been there for a few days. The CCI 14 is now on the list. And as I said, the shorter term stochastics. Intermediate term, we still have our ADX chart because it's above 40, but it is dropping below the moving average. The 50-period moving average study, the rate of change going back 50 periods, the PMO and the PMO studies that we look at, yeah, they're turning over and rolling over and dropping below their moving average, but they're still extreme positive, as are most of our oscillators right now. The bullish percent index for the S&P and the NASDAQ, yeah, they're rolling over too, but they're still above that 70 level. And then our new high, new low study based on 10 periods for the S&P, that's still camped up in extreme positive territory, and it's going to take some time for that to react. We are still above the extreme readings with the 150 and 200 period moving average studies. And we're still going through this scenario that the Fed may be done raising rates and possibly even cut rates, even though that percentage is starting to drop down a little bit. I'll be going over the Fed charts in the weekend videos. But now, after we had the meeting minutes that were released, the Fed might be willing to raise rates if we see some economic strength. So that's why we're really paying attention to the economic reports that are coming out. The dollar was up and interest rates were also up. We actually got up at the 4% level on the 10-year yield, but then we ended up closing at 3.99%. The 10 to the 2 and the 10 to the 3 month, those yield curves are still inverted and they're becoming even more inverted. Sentiment is still positive. It actually ticked up even though we closed down. A lot of that probably had to do with the initial strength that we saw earlier in the session, and that didn't really shift over into sentiment. We're below the 75 level, but we're now at 74 where we had been at 72. Our trend is still positive. The green line's on top, but it's coming down. It's also a weakening trend, falling below the moving averages. Our bias is negative and our momentum is negative as well. The economic reports that came out, we had the ADP employment change. It came in at 164,000. That was greater than expected. They thought it was going to come in at 114,000. Last time it was at 101,000. Weekly jobless claims came in weaker than expected at 202,000. So both of these together are showing some economic strength. They expected 220,000. Last time it was at 220,000. My goodness. The continuing claims are at 1.855 million, a little bit down from the 1.886 million that we saw last time. And then the global services PMI, the final reading, it still is above 50. So it's showing a little bit of expansion in the economy. It came in at 51.4. Last time it was at 50.8. Here are some charts showing the ADP employment change. And this is starting to go back up. Now, we had the JOLTS job openings, we have ADP, then we're going to get the employment situation report on Friday, and we'll kind of have to mix all of this together to see how the employment situation is looking. But we have shown some strength here, and this is what the Fed used to justify raising rates if this really starts to go back up. If we see other employment reports show some strength, that's going to really spook the markets that have pretty much assumed that the Fed's going to start cutting rates. And we look at the services PMI, which is showing a little bit of an expansion here. It is above 50, so it's improving over the last few months. Here are the weekly jobless claims where they did tick up. The moving average, the blue line, that's what we follow. It's starting to level out a little bit. And if it starts to go back up, that would actually show some weakness in the overall economic situation. But we're seeing the moving average still going down with the continuous claims here, even though it ticked up a little bit in the latest reading. So we have all of these together. The red line is the initial claims, then the blue line are the continuing claims, and then we have the unemployment rate, which will be updated in Friday's session. Here is the unemployment rate. It's currently at 3.7%. We'll have to see what they come out with on Friday. I do have some charts. I used to go over all of the Isabel Net blog charts every day, even when I found them confusing, because the charts that I use, I built myself, so I understand the logic that goes into them. sometimes looking at these charts, you really can't figure them out. It's like, what's going on here? And to kind of shorten the videos, or at least prevent it from becoming even longer, I look at the Isabel Net blog charts every day, but unless they're really telling us something and they feed into what I'm talking about, I usually don't include them. Well, here is the average median return by month, showing that we average anywhere, or the median is anywhere from 1.56% to 1.54%. And so far, at least when this chart was created, we're down 0.5%. We're actually down over 1% now. And this just gives you an idea of what the percentages are like throughout the year. October tends to be the weakest month of the entire year, as we witnessed back in 2023. And then stocks go up and down. And that's something that I really like to stress. My philosophy is, okay, if you look at a long-term chart of the S&P or the Dow or pretty much any index, a huge percentage of the time, I haven't actually figured out the percentage, but 85, 90% of the time, the markets go up. So that means you should have a bullish stance 90% of the time, if that's what it actually is, 85%. But then there are times when the market goes down, and that's a shorter percentage of the time, but it's a realistic time, and it's a time when you can make some really good profits, and you can also avoid a lot of pain where most people just have to ride this out. And that's just the reality. I'm not a perma bull. I'm not a perma bear. I like to consider myself a realist by making the charts prove to me every day what's happening. When I sit down and look through all of the charts, I have no opinion. I let the charts tell me what's actually going on. It's when people run into trouble, it's when they try to forecast ahead what they think is going to happen, because they think that the way things are right now is the way things are always going to be. And if they're more optimistic or pessimistic looking forward, that's the conclusion that they're going to reach. Where my approach is more day by day, evaluating things. And then, okay, this is what I've concluded for yesterday. Is that still continuing today? All right. And again, I don't know why I got off on that, but that's more my philosophy. You may agree or disagree with that. It's worked for me for decades, and it has actually enabled me to develop foresight, to see things before they actually happen, at least on a day-by-day basis, not necessarily looking out into the future, because I just evaluate things one day at a time. But this, you can pause this and look this over, and it just shows that there are up times and there are down times in the market. And then this is the median 2-week returns for the S&P 500 going back to 1950. This was the second half of December and then the first half. This is historically what has happened. We're not even close to that yet. We've been down on the year so far. And then we have the ISM Manufacturing Index. That is the area, and I have to move this because it's blocking the top part of the chart, where the gold line is the ISM Manufacturing, and that is starting to pick back up. The purple line is the S&P 500 on a year-over-year basis, and they're both starting to show some improvement. And now I can't advance the slide. All right, and then large cap versus small cap. It's still showing when we do a ratio between the two, and I go through this in the intermarket analysis video and in the weekly video, where the small caps have really been underperforming. But then later in the year, and this is kind of an inverse of what you would think, because we saw the small caps really outperforming. So this ratio was actually going down, but now it's been starting to show some weakness. Then here are, and I don't know if, is it the Magnificent Seven? Is it the Great Eight? Is it the Illustrious 11? I'm not sure how many are in the number here, but here's the top 7 companies in the S&P 500, and they account for 30% of the index. That's why we look at the S&P and the equal weight S&P, and this is showing how they're contributing most of the strength to the S&P. All right, let's go back and look at our intraday charts first, where we had pretty much a flat open, and it looked like, okay, maybe we're going to get a bounce here. And we did initially. We went above the daily pivot. We got up to R1, but then we stalled out there. We fell back, tried to find some support along the daily pivot, came down to the unchanged level. We're able to hang out above that. but then we started to break down below it, and going into the close, we saw some more selling and ended up closing below S1 at the low for the day. Intraday, we were looking okay in the initial overnight session, a little bit of strength, and then that started to wear off as we got closer to the open. We did see the bounce during the day and then the weakness going into the close, and we're up just a little bit in the initial overnight session. This is a concern, and we've been seeing this for a while now, where the blue line, which is growth, it's really underperforming value. And value was down, but barely down, where growth was more down here. And when we look at the growth to value ratio for the S&P, this has also been a concern where we've been seeing some overall weakness. And this goes back when we were seeing the big run up back in December. This was still not really going along for the ride. Then we saw this real gap lower to start the year, and then we ended up going down again in Thursday's session. Here's some end-of-day charts showing how growth was down much more than value for the large caps. It was about even for the mid caps and actually a little bit better for the small caps. And so here are the growth to value charts where we're going down overall when we compare growth to value for the small caps. We're also ticking back up just a little bit and showing a little bit more strength here with the mid caps, even though they have seen some recent weakness. But this is the concern. The S&P growth to value ratio just continues to go down. Another few days, if we don't see a real nice bounce, this could actually generate a death cross for the first time in quite a while. Looking at discretionary versus staples, we look at the ratio along the bottom. It ticked up a little bit, but has been showing some weakness. Then looking at our trend, we are below the moving average and going down, but we're still above 40. That's why it's still on the extreme list. The green line is on top, but it is declining. The red line's starting to come up. If we see a cross here, then we would shift over to default to the negative side, but we're not there yet. Looking at the short-term chart, going down faster. The green line's also going down faster below its moving average. Volume is starting to pick up, but it's going to take a while for this oscillator to get above zero. Sentiment, we're seeing a bit of an advance here with fear when we look at the Ulcer Index. The VIX is starting to pick back up a little bit on the line chart as well as the bar chart, but we're not really seeing an advance for the VIX of the VIX. So the volatility of the VIX is not really doing much. It's pretty much chopping sideways. It actually declined on the line chart. This is another chart that we've been watching, which is a correlation between the VIX and the S&P. We're getting back up to this dashed line. We haven't crossed above it yet, but if we do continue to go up, spike, and then come down, that is usually negative for the market. We'll see if things continue to play out this way. The equity put call ratio continues to go up, even though it was pretty much flat on the day basis. But this is rather encouraging. We've turned back down now with the 5-period equity put call ratio. So that's short to intermediate term positive and not giving us an extreme reading right now. We did go back up with this other fear gauge that we follow. We had the latest reading of the American Association of Individual Investors. They had been extreme positive. They came down a little bit. And then, of course, because a week ago things were positive, they're more optimistic and not quite extreme, but kind of extreme at this point. We look at the risk on to risk off ratio. We're seeing more weakness here. In fact, I've had to switch that over to the warning sign slide later on in the video. The advanced decline line, we're still hanging in there based on price and volume, even though we are declining. We're still flatlined with our 5-period new highs minus the new lows study. We're declining with the 10-period. We're seeing a drop off in the new highs, but we're to this point, and you can take this as positive, we're not seeing any kind of a real expansion in the new lows. The advanced decline ratio continues to decline, but it's still above zero. Accumulation distribution rolling over, but still above the moving average. If we drop below the red line, that will turn things more negative according to the smart money. And the Chaikin money flows, no longer extreme, starting to come down. It's still positive, but it is declining. We did see a decline with the cumulative NYSE advanced decline line and a little bit of a decline with our regular advanced decline line. And we're coming back down now with the S&P here, and we're declining with our other NYSE advanced decline line. And we're coming back down on, this is what I meant to talk about in the previous chart. We're coming back down a little bit faster now based on price than we are with volume. Okay, that could be negative, showing that price is going down quicker than volume. You could take that as positive in that volume is not coming down as fast, because sometimes volume will be a leading indicator. The advanced decline line studies were declining pretty much across the board with the NYSE common stock, the S&P mid caps, and small caps. Our daily chart, we were kind of hanging on to this pivot point here and also this previous low that we set during that down day in December. We've now broken below that. So that's usually not a good thing. On the bottom, we are picking up a bit with volume and coming back up to the moving average. We're no longer extreme with our 20-period moving average study. We're rolling over, but still extreme with the 50 as well as the 200. We're just barely starting to drop down below that extreme reading. The Stoke RSI continues to be extreme negative. The Williams %, that's a new addition to the list. After being extreme positive for most of November and December, it's now getting extreme negative. This is a pretty touchy indicator. The CCI 14 is starting to get extreme negative. And we did come down and actually close below the 20-period moving averages here on this study. That's a bit of a warning sign here for the short term, the fact that we were not able to bounce up off of that. Now, we could recapture that, especially if the employment situation report comes out, the market reacts to it and decides to do a lot of buying. Yeah, we could get that back. But for right now, this is looking more negative. We are turning more negative with the force index. As we were going up with the S&P, we were seeing a negative divergence here. We're now turning more negative and dropping below zero. And here's the stochastics. In the short term, we're already extreme negative. We've turned negative now with the intermediate short term since we dropped below the midpoint. And we're rolling over, but it's still extreme positive with the long short-term stochastic. So take that for what it's worth. We're starting to drop below the midpoint here on our standard deviations chart. We are dropping, but still positive with the balance of power. We're continuing to be more neutral with the lighter shade of blue bars for the go, no-go system. We're dropping below the midpoint with our highest high, lowest low value study. And we continue to show the darker shade of blue with the TTM squeeze. We're dropping further below the double exponential moving average. That's the blue line. We were thinking that might provide support. Nope. For right now, it has not provided support. And we're just about ready to cross over negative with the ease of movement. We had been positive and going sideways. Now we're starting to see more weakness. Not really seeing a big change here with the Erin. It continues to be flat. It's still positive because the oscillator is still above zero. We're continuing to fall further below the zero line with the S&P McClellan oscillator. So we're turning down based on price, and we're also turning down and looking lower based on volume. The NYSE McClellan oscillator continues to decline below zero. That's negative. We're rolling over based on price as well as volume with the NYSE summation index studies. And we're dropping below zero with the Swenlin trading oscillator based on price as well as volume. We're rolling over and going below the moving average with our PMO. We've already crossed below the moving average based on price, and we actually went a little bit before that based on volume. So we've been seeing this negative divergence with the PMOs, the percent of PMOs that are rising as the S&P was going up. Also saw a negative divergence with the buy signals, but we're still extreme positive with the PMOs that are above zero. We continue to be negative with the Elder's Impulse system for the S&P. We're also negative with the parabolic SAR. We're rolling over, but still extreme with our slope oscillator. The MACD is also turning more negative after giving us an extreme positive reading. So looking at all of our oscillators, we're turning down, but we're still extreme in the short term, rolling over with the MACD, the PMO, and the PPO. That's turning more negative. But we're still extreme with our long-term oscillators, the TRIX and the KST, but we're dropping below all of the moving averages with each oscillator. And we're falling below the 20-period moving averages with our moving average tree. That's short-term negative. We're coming down with the bullish percent index for the S&P, but we have not crossed below 70. We're turning down with the NYSE bullish percent index. We're also declining with the NASDAQ 100 bullish percent index and have not crossed back below 70 yet. We're kind of sideways right now with the Sean trend meter and no longer extreme positive. The Chaikin oscillator, and this sometimes actually gave us a bit of a heads up. It started to go down before we saw the decline in prices. It's dropping more negative now since it's falling below zero. The Bollinger Bands were dropping below the midpoint. We're starting to turn a little more negative with the money flow index. We're just barely above 50, but it is declining. The ultimate oscillator crossed below 50 yesterday. It's continuing to decline. The vortex, the green line's still on top, but it's now crossing below the midpoint as the red line is advancing. The rate of change still is continuing to be extreme positive. The RSI 14 is declining, but still above 50, where the shorter term RSI 9 has now dropped below 50. On balance, volume is declining, but still above the advancing moving average. And we're starting to turn down with our 200 period moving average study, and we're starting to roll over a bit as well with the 50 period moving average study for those stocks in the S&P 500. The Pring bottom fisher is still partying like it's 2023. With our line studies, we did start a new cycle on January 2nd, and we've been declining ever since then. We're coming down to the lower part of this mini rainbow with our 20-period simple moving average of the open, high, low, close. Will that end up providing support, or are we going to fall through that? We're turning more negative with the Heiken Ashi chart. We're also negative with the Kegi chart. We're still blissfully happy with the Renko chart since it's positive. We're looking more negative with the 3-line break chart. And we're still extreme positive, but coming down with our 150 and 200-day moving average study. We're still above this longer-term trend line on this weekly chart of the S&P, with this trend line going back to the 1987 crash. Are we going to come down and test that, or are we going to be able to bounce back up off of that or stay above it? And then we're coming back down below this trend line when we look at the NASDAQ 100 going back to 2009. We did see some weakness in the equal weight as well as the S&P 500. So when we look at the ratio, we were down just a little bit, but for the most part, the broad market held up better than the mega caps. And this is where we're seeing another negative divergence. We were actually up slightly with the Dow. We were down slightly with the transports. We were down a little bit with the utilities, but it's this negative divergence between the Dow and the transports that has had us concerned for quite some time. The transports are still underperforming the Dow. The Dow is virtually unchanged, but it was up on the day, so it's holding up a bit better. But the Elder's Impulse system for the diamonds remains neutral. We're looking a little more negative with the NASDAQ, where we're dropping down, and it's a little bit of a scarier looking chart. Also for the NASDAQ 100, also dropping below support and continuing to decline. We continue to be negative with the QQQs when looking at the Elder's Impulse system. Momentum for the NASDAQ 100 continues to be negative with the PPO dropping below its moving average. We have been able to hold on to support here with the small caps. Are we going to get a nice little bounce up off of that or end up falling through this pivot point? But we continue to be negative with the small caps when looking at the Elder's Impulse system. We did lose this support level after Wednesday. We're still below it now. The longer we stay below this, if small caps start to go back up, the more this will act as overhead resistance. On a momentum basis, we are also negative. And with the RSI on the top, we've now dropped below 50. The mid caps have closed 2 days now underneath this pivot level. So that's a bit more negative. And they remain negative with the Elder's Impulse system when looking at the mid caps, where the financial sector continues to look stronger. It continues to be in an uptrend and was up in Thursday's session. The FANG index was down a little bit over 0.5%, but it's still above its 50-day moving average, and it's still in a longer-term uptrend. If we continue to fall, we'll be watching this red line here. I'll probably extend that over to see if that provides some kind of support. The dollar is paring back on some losses that it had. So that's been showing some improvement, even though shorter term, we're in a downtrend. Longer term, we're still in an uptrend. We were up with the 10-year yield. We were down based with the 10-year on price. And this is the historical chart where back in November, when we hit that 5% level, and now we're starting to come down, other times when we saw a spike in the 10-year, that usually meant that something bad happened. We don't really know about that yet. It may come out at some point. We don't know if it'll be different. There's been other spikes along the way here that we're not necessarily part of some kind of a major breakage in the economy. So we don't know if this is going to play out that way or not. We're still positive with the 1-month yield and subtracting the 3-month yield. But when we look at the daily chart, we're going back above and looking more normal on this chart. Growth to value is just not holding up right now. The Qs are underperforming the S&P. Discretionary is also underperforming the S&P. Large cap growth is underperforming large cap value. Our growth to value ratios, we're showing pretty much across the board weakness in the large caps, mid caps, and small caps. We're still pegged at the top with our 10-day average of the S&P 500 highs minus the lows. Eventually, 10 days are going to catch up, and we'll see if that has a reaction with this indicator. We're still positive with our 5-period moving average of the highs minus the lows when we look at the Amex, NASDAQ, and NYSE, but we have been declining. Our 50-period exponential moving average of the new highs, new lows study, it's rolling over just a little bit, but continues to be positive. The 2-year Treasury yield, it was up in Thursday's session, so it's going back up just a little bit, but overall it has been declining, and that has been giving support to the S&P. Can we get that back? It doesn't seem to be really helping right now. And we're starting to go back up with our staples to S&P 500 ratio. When this goes up, that tends to put the S&P under pressure. So what's our outlook for Friday? Is the January effect over, or are we going to be able to kick back into gear? The technicals are still positive overall, but we're starting to see some weakness. Our charts are just not looking as strong as they were. It would have been nice if we could have bounced off that 20-period moving average and used that as support. That would have suggested that things were turning more positive. The idea that we've now closed down below that is throwing that a bit into doubt. We will get the employment situation report as well as factory orders. The other big report is going to be the ISM non-manufacturing. And then keeping an eye on all the different geopolitical events. There's things going on in the Red Sea. There's things going on in Israel. Of course, there's still a war between Russia and Ukraine. Any one of those things can always have an impact on the markets one way or another. And then here's the economic calendar. I'll have the updated calendar when I do the video for Monday's session. Seasonally, we are neutral to positive across the board for January 5th with the Dow, S&P, and NASDAQ. We will be on the 4th trading day of the year where we are kind of a little bit positive here, but then we see some negative seasonality after this during an election year. And this is the measurement of the January effect, where we're wondering, is this just a little skip before we get set to go higher, or are we going to see more of a decline? Is this going to recover at some point? Right now, that looks doubtful, but anything can always happen and things can always recover. We're also looking at 1982 because it looked a little bit like what we were seeing in 2023, where after that, we ended up seeing strength going forward. But when we look at an election year, it tends to start out sideways. Well, we're not really going sideways now. We're going down more, but we see a lot of choppiness to start the year. And we're also seeing that choppiness here with the Stock Traders Almanac chart when we look at the green dashed line. But this chart kind of goes against that. When you have the sitting president that's running for re-election, until we hear that maybe that may not be happening, we don't know at this point. But this tends to be more positive when that ends up happening. Friday tends to be the second most positive day of the week. We're up with an average gain of 55.5% in 2023. And then when we go back to 1950 during an election year, we're 50-50 across the board with the S&P 500. So our scenarios, it's hard to go with the down one, even though we are starting to show some weakness. We're not really switched over yet to a full-blown negative stance, but any more follow-through and that could change, but we're just not seeing the confirmation yet on the charts. If anything, we still default to the positive, but we don't want to go against what's happening. That's why I don't buy on dips. If I'm looking to go long, I only go long if the market is up. And it's been down every day now. So it's prevented entering any kind of long positions, at least according to my philosophy. We're still kind of concerned about the ADX charts. They are dropping below their moving averages, but they're still both above 40. The warning signs, growth is showing weakness, and we've been seeing that now for quite some time. The risk on posture that had to be added back to the negative slide here. It's showing recent weakness. The transports continue to negatively diverge from the Dow. The 1 to 3 month short-term bond spread continues to be positive. It should be negative. The parabolic SAR chart and the Copic curve chart both are negative. Our S&P 500 oscillators, I also switched that over to this slide as well. We're rolling over after being extreme positive. And the PPO, which is the momentum oscillator we look at for the NASDAQ 100, it continues to be negative. Positive, we still have the daily special K chart, the equity put call ratio, that's back on the positive side now. It's going down. And our longer term equity put call ratio also is continuing to go down. The Vortex is still positive, but showing some weakness. The bullish percent index is extreme positive, but also showing some weakness. The Zohorchak method, we have not seen a change with that. We did generate recent golden crosses with the Russell, the small caps, and the mid caps. Small and mid cap growth is positive, but chopping sideways. The financial sector is positive, and I did change this. Believe it or not, I changed this. You should be able to see this. This is the new high, new low study based on the S&P 500 on 50 periods, and that continues to be positive. So our conclusion, we are positive, but weakness is developing. In the short term, we are still seeing weakness. Is that going to continue? And will the 20-period moving average end up providing support? No, it hasn't to this point. And I really thought I changed this. There's something wrong here. We are positive, but we're seeing more weakness developing in the intermediate term. And in the long term, we continue to be positive since we're above the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.